Welcome back to another video, guys. In today's video we will be making 4 quick predictions about the real estate market for 2022, and hopefully we can make some conclusions on what is going to happen in the market right now. So let's get to the board. Number 1, Feds will raise rates. So if you are keeping in touch with the real estate market and mortgage market right now, you probably already know that the Feds already did a hike about 2 weeks ago. The average rate prior to this raise, we're sitting at around 2.99% for buyers looking to purchase for primary property, first-time buyers, and now that rate is close to 3.40%. So they have raised the rates close to almost, raised the rates by almost a half a point already. So now this may sound that it's bad news for us brokers or lenders and buyers that are looking to buy, because now a lot of buyers may not qualify or your payment may have gone up a tad bit. But usually when this happens, it's a good indicator that the economy is doing well. Now, why do I say that? A good way to check, a good indicator that's been there for almost decades is the 10-year U.S. Treasury yield. So usually the 10-year U.S. Treasury yield is proportionate with the mortgage interest rate. So when the Treasury yield goes higher, the interest rates go up. Now I'm only talking about 30-year fixed mortgages. So what this is the government, what that means is investors are investing more in private instruments like stocks and investing less in government bonds and notes. So the government increases their yield to attract more investors. Now, mortgage-backed securities, MBS, which are tied to mortgages, target a similar kind of investor. So as the government raises its yields, so do the mortgage-backed securities. They also increase their rates. So what does that mean to the investor? So if you're obviously to up, goes higher, but what that does is it's giving the investors that are buying more of a return. So that usually is an indication that investors are believing in the economy, investing in private equity. So it's a good thing that the rates, it's not necessarily a bad thing, right? So now we are due for another hike this year. There is belief that rates will be closer in the high 3s, because if you guys remember, before the pandemic happened, the rates were closer to 4%, a little above 4%. So we may see rates go back to that mark around this time next year. But right now, we're hoping that they'll be between this mark. So number 2, majority of the refinances that were, or the financing deals that were happening in the mortgage industry last year were primarily rate and term refinances. Folks that were looking to get a better term and rate for their mortgage. And those were the majority of refinances. This year, we are not going to see that. We're going to primarily see cash out refinances. People that are looking to pull money out of the equity they have gained in the last 2 to 3 years to possibly do other investments, to save some money for maybe investments in the future, or do some debt consolidation or rehabs of their property. A lot of people are not going to be doing a rate and term refinance, because that boom is sort of over now because the rates have gone up. Number 3, home price growth. The appreciation that we've seen in the last 2 to 3 years, where it's been an appreciation for almost all, in some areas, from anywhere from 15% to 20%, we may see that appreciation slows down a tad bit and it comes to more of a normal, healthier number, as it usually does when interest rates go up. And that, what causes that is, as interest rates go up, people slow down. A lot of buyers that were qualified may not qualify. A lot of buyers may hold back because they think the mortgage rates are gone up. And so we will see that happen, and I'm hoping that that happens, because that will sort of push us into a more of a healthier market, where we'll start to see the inventory, more inventory coming in, and the demand coming down, so we can come to a more of a healthier level. Number 4, employment and income growth will continue this year. There was a stat that was put out by the U.S. Bureau of Labor Statistics that said that individuals that were 25 years or older with a bachelor's degree, the unemployment rate for that stat was 2.1% compared to the overall unemployment rate of 3.9%, which is still very, very, very low. So a lot of our young generation that are coming out of colleges have lots of opportunities, actually high-paying job opportunities available in the market right now. Almost 10 million jobs are available that need to be fulfilled. A lot of them being professional services. If you look at the stat, you'll see a lot of them are hospitality. That's because a lot of the hotels are ramping back up and getting those jobs back online, and a lot of these jobs are technology jobs. So even though we're seeing signs of inflation, hopefully with the high-paying jobs, we can sort of balance that out. So what does it mean to you, the buyer, to you, the seller, to you, the real estate enthusiast that is looking for opportunities in this market? It means that the market may slow down a little bit as interest rates are on the rise, and we are hoping to see days on market increase from being 6 to 8 days, hoping it goes from 15 to 20 days, which gives buyers more choices out there in the market, and we can sort of slow this crazy frenzy buying and come to more of a healthier market that we were in prior to the pandemic. Number two, we are not seeing any red flags or signs of a recession at the moment. Like I mentioned on the board earlier about the job growth and where we are as an economy, there are no signs or red flags of a recession at the time. So if you're in the market, you will still see consistent growth for the in equity for the properties that you are purchasing. Number three, I'm going to piggyback off on number two. There will be steady growth in equity, but it may not be the numbers that we saw in 2020 and in 2021. There might be more of a healthier growth, appreciation of closer to the 8 to 10% mark instead of being the 15 to 20%. That's it for today, folks. Like always, please don't forget to share, like, and comment, and don't forget to follow us on our pages to stay on top of your real estate game. Until next time, this is Karan saying with Optimal Loans.